At 42, Darius earned $16.25 an hour. That number stays fixed. His paycheck does not. 1 week brings 30 hours, another brings 38. Rent, the phone bill, transit, and the car due date do not move with the schedule. The average says he has enough. The low month says he is $110 short. That contradiction is the late starter problem this video will solve. Not whether Darius works hard enough, not whether every low-income worker should enter a trade, and not whether one small purchase proves anything about character. The problem is a transition system in which variable schedules, ambiguous training economics, and upfront job change costs make a higher wage route difficult to verify and finance. That mechanism has a name: the wage ladder friction tax. It is not a government levy. It is not the difference between two wages. It is not a lifetime invoice. And it is not proof that Darius is lazy, impaired, irresponsible, or surrounded by the wrong people. The wage ladder friction tax is the option cost and finance pressure created when the next rung may be real, but the worker cannot yet see a dependable income floor, a paid skill path, and a funded bridge to the first paycheck. Darius is a fictional composite. He is 42 and works as a restaurant shift leader in Memphis. He has 25 years to age 67 as a planning marker. His wage is $16.25 per hour. Across 13 recent weeks, his schedule ranged from 30 to 38 hours. The average was 34 hours per week. At that average, his modeled annual gross is $28,730. $16.25 times 34 hours times 52 weeks. His 4 recent modeled take-home months were $1,820, $2,080, $2,170, and $2,330. The average is $2,100 per month. His tracked monthly outflow is $1,930. That includes a scheduled $180 card payment. At the average, his margin is $170. In the $1,820 month, the gap is negative $110. He has $450 in cash, $3,200 in retirement savings, and $6,100 on a card charging 24.99%. His narrow-tracked position is negative $2,450, $450 cash, plus $3,200 retirement, minus $6,100 card debt. That is not Darius's complete net worth. It excludes personal property, benefit rights, taxes, unlisted obligations, and every non-financial source of value in his life. It is only a consistent baseline for this case. The Federal Reserve's report on household economic well-being in 2025 provides broad context. 30% of adults said their income varied at least occasionally through the year. 11% said income variation caused difficulty paying bills. Lower-income adults were more likely to experience both the variation and the hardship. Those population statistics do not calculate Darius's outcome. They show that a moving paycheck beside fixed due dates is not an imaginary problem. Now look at the first mechanism, the Schedule-Variance squeeze. A monthly average compresses high and low pay periods into one clean number. But bills are not paid with an annual average. They are paid on specific dates from the cash available that week. Darius's $2,100 average suggests a $170 margin. The $1,820 month produces a $110 gap against the same outflow. Both statements are true. The average measures the center. The low month reveals the failure point. The blocker is an income floor ledger. Darius uses 13 weeks of schedules and pay records, not a guess about what his manager might schedule next. The ledger records 4 things: hours actually paid, take-home cash by pay date, essential bills by due date, and the lowest repeatable month a current job must survive. The Consumer Financial Protection Bureau describes a cash flow budget as tracking the timing of income and expenses, often week by week. That is what changes the picture. Darius is not told to budget from a perfect month. He tests the $1,820 month. The ledger exposes the $110 gap before a due date turns it into another car charge. It also gives his first blocker a personal cash target, not 3 months of expenses, not a universal $1,000 command. Darius chooses a $1,500 Offer-to-Paycheck Bridge. $850 is assigned to his personal shock reserve. $650 is assigned to verified tools and transition cash. He begins with $450. The amount to build is $1,050. For 6 average months, $170 moves to the bridge. Cash reaches $1,470. In month 7, $30 completes the $1,500 target. The remaining $140 stays planned flexibility. This model assumes the average margin occurs during those months. If the low month returns, the completion date moves. The target does not justify missing food, housing, medication, utilities, or required payments. The Consumer Financial Protection Bureau says an emergency fund amount depends on the person's situation. $1,500 is Darius's case decision, not the correct number for every household. Now the second mechanism appears: training pay ambiguity. The phrase "learn a skill" can hide tuition, unpaid class hours, tools, licensing, transportation, admission rules, and no guarantee job. A national wage median can make the path look complete before Darius knows the starting wage in one actual offer. A course advertisement can describe a future occupation without describing the cash gap between enrollment and the first paycheck. The blocker is a paid ladder file. The file has 7 fields. Is the program registered or otherwise independently verified? Is training paid? And which hours are paid? What credentials earned? What wage progression is written? What tools, transport, licensing, and health costs are required? What completion and employment conditions apply? And what actual job term exists after the research? Apprenticeship.gov says a registered apprenticeship is a paid job with structured on-the-job learning, related instruction, progressive wage increases, and a portable credential. That describes the federal program structure. It does not guarantee an opening, admission, a particular trade, or one local wage. The Department of Labor also says American Job Centers provide job search, career, classroom, and work-based learning services. Darius can ask about programs and possible support. He cannot record a grant or benefit in his plan until eligibility and an award are verified. For this fictional test, Darius investigates heating and air conditioning work. The Bureau of Labor Statistics says HVAC technicians typically need post-secondary instruction, although some enter with less education, and some train through apprenticeships. It also notes that licensing or certification may be required, schedules can vary, and the work can involve physical hazards and difficult conditions. The national median wage was $59,810 in May 2024. That median is broad occupational context. It is not Darius's entry wage. It is not a promise that he will complete training, be hired, remain employed, or earn the median. The paid ladder file converts broad context into a small evidence test. Darius submits 5 applications to verified paid opportunities that fit his transportation and schedule constraints. In this fictional case, 5 applications produce 2 interviews and 1 written offer. That funnels Darius's test, not a universal formula. The offer specifies $20 per hour, 40 paid hours per week, employer-sponsored instruction inside the paid schedule, an employee health premium of $150 per month, no employer retirement contribution during the first year, a required tool list costing $650, and a start date plus first paycheck date. The current job average is $16.25 for 34 hours per week. That is $28,730 of modeled annual gross. The offer is $20 times 40 hours times 52 weeks. That is $41,600 of annual gross. The gross difference is $12,870. Now price the known transition terms. Darius's current employee health premium is $110 per month. The offer premium is $150. The difference is $40 per month, or $480 per year. Current transit is $68 per month. The offer route costs $120. The difference is $52 per month, or $624 per year. The verified tools cost $650 once. $12,870 minus $480 minus $624 minus $650 equals $11,116. That is a known first-year comparison before income taxes and out-of-pocket healthcare. It is not take-home. It does not include future raises. It does not guarantee completion or continued employment. And it is not a wage ladder friction tax invoice. It is one fictional written offer compared with one current job baseline. In Berkshire Hathaway's 2007 shareholder letter, Warren Buffett described a preference for long-term competitive advantage when evaluating a business. He was discussing businesses, not telling workers which trade to enter. The narrower lesson is an evidence boundary. Darius does not call a skill valuable because a slogan says skills pay. He asks whether one verified path creates paid learning, a portable credential, written wage progression, and an actual offer he can finance. The paid ladder file, not Buffett's letter, supplies the worker-specific answer. Now the third mechanism can be blocked. The transition cash gap. A better annual wage does not pay for tools today. It does not cover the days between the old final paycheck and the new first paycheck, and it does not replace written health, schedule, transportation, or start date terms. The blocker is the offer-to-paycheck bridge. Darius does not quit because of the national median or a verbal promise. He waits for the written offer. He confirms the start date, paid hours, training schedule, first paycheck date, health premium, tool list, commute, and any licensing condition. His $1,500 bridge already has 2 jobs. $650 pays the verified tools. $850 remains as his personal shock reserve. The cash did not disappear into an unexplained transition. It performed the job assigned before Darius changed employers. Now test a card route. During the 7 bridge building months, Darius continues the scheduled $180 card payment. The model assumes no new charges, a constant annual percentage rate of 24.99%, monthly compounding, month-end payments, and no added fees. Under those assumptions, the card balance after month 7 is approximately $5,705.24. The fictional offer begins in month 8. Darius's new model take-home is $2,700 per month after payroll deductions and the employee health premium. His updated tracked outflow is $2,050. That includes the $180 scheduled card payment, $120 transit, and $150 employee health premium. The new modeled margin is $650. $500 of that margin is added to the card payment. $150 remains for reserve recovery and planned flexibility. The total modeled card payment becomes $680 per month. Under the same assumptions, the card is paid in month 17. The final modeled payment is approximately $217.16. Total modeled interest from month 1 is approximately $1,497.16. Actual issuers may calculate interest daily and may use different cycle lengths, rates, fees, and payment allocation. The real statement and card agreement control. The payoff is a model, not a promise. It also is not added to the low-month gap or the offer difference to manufacture one dramatic tax total. After the modeled payoff, the $680 card route is assigned before another claim arrives. $450 per month goes to retirement. $130 goes to opportunity and reserve cash. $100 remains planned flexibility. The separate $150 margin line remains available for reserve recovery and real-life variation. Now the 25-year runway can be illustrated without pretending markets are fixed. Darius begins with $3,200 in retirement savings and no current monthly contribution. The runway to age 67 is 300 months. In the baseline illustration, the existing $3,200 remains invested with no new contributions. At a fixed nominal 5% annual return, it becomes approximately $11,140. At 7%, it becomes approximately $18,321. In the action illustration, no contribution is added during the 17-month card route. Then $450 is contributed for the remaining 283 months. At 5%, the modeled ending value is approximately $253,461. At 7%, it is approximately $341,271. The modeled difference is approximately $242,320 at 5%, and approximately $322,950 at 7%. Those differences are not money Darius is currently losing. They are not wage ladder friction tax invoices. They are nominal fixed return illustrations before fees and taxes. Markets do not deliver fixed returns. Job continuity, contribution timing, investment choice, inflation, taxes, fees, withdrawals, and market sequence can produce materially different results. The figures exclude Social Security and do not prove retirement adequacy. Age 67 comes from the Social Security full retirement age schedule for people born in 1960 or later. It is a planning marker, not an instruction about when Darius must retire or claim benefits. The wage ladder friction tax is not broken by motivation. It is blocked by evidence and sequencing. The Schedule-Variance squeeze is blocked by the income floor ledger. Training pay ambiguity is blocked by the paid ladder file. The transition cash gap is blocked by the offer-to-paycheck bridge. Pressure becomes analysis. Analysis becomes relief. Not because Darius escaped every risk, because the low month is visible, the skill path is paid and verified, and the transition is funded before the old paycheck stops. If you are a late starter between 38 and 52, Do not begin with a slogan about escaping low income. Begin with 3 documents, 13 weeks of actual pay and due dates, 1 paid ladder file with program and offer terms, and 1 bridge from the current paycheck to the first new paycheck. Do not count a wage until it is written. Do not count funding until eligibility is verified. Do not leave the current rung until the next rung can hold your weight. That is how a wage ladder stops being a promise and becomes a route.